As the results of the present activities in the world right now, the market is going nuts, right? So, I made my research over hundreds of companies, and this list of stocks is my personal list to watch out for. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. Watch till the end so you can get the complete analysis of the companies on my list. First on my list is the Intel stock ticker Incorporated. This US-based multinational technology corporation is especially known for the production and distribution of semiconductor chips and microprocessors. Right now, one stock share costs 47.38 to 52-week low of 43.63 and a 52-week high of 68.49. Analysis of their one-year price chart has shown a minimal decrease in price in 2021, attributing to a few major concerns along the way. However, back in April of 2021, we did see an increase of about $70 per share, but after that, we have only seen decreasing numbers up to 30%. Yahoo Finance has marked them as near fair value, and if we take a look at the evaluation measures, we see that they have an expected 5-year PEG ratio at 2.67 and a 1.92 price to book ratio. This gives a very healthy profit margin of 25.14 as well as a robust 22.52 return equity. The company has seen revenues of about 79 billion in the last 12 months. If you look into their balance sheet, you can confidently say that they have at least a total of $28.41 billion, and in terms of current ratio, they are at 2-to-1. In the last month, there are more analysts that moved over to strong buys and buys 54.40. Because of this, the House of Representatives passed the China Competition Bill that permitted the allocation of $52 billion to semiconductor companies, including Intel. They fund various semiconductor manufacturing companies. Well, just like Intel. The US provides capital and resources for Intel to compete against China's largest technology companies. The more money invested in these types of companies is obviously a good sign for Intel, whose biggest competitor is AMD. Intel, however, has a huge advantage because they make their own CPUs and semiconductors. This means they can vertically integrate their business and sell their products at a lower cost. Unlike AMD, which depends on third-party manufacturers and sources to produce their products. This forces AMD to adjust their manufacturing costs, and the reason why their new products are priced over $200. Since Intel can sell its products at a cheaper cost, it has more appeal in the lower gaming market, which gives them a solid competitive advantage. Since the fact that Intel will benefit from the government's intervention, this will have its advantages over competitors. I do think, however, it's a safe say that Intel is definitely one of the stocks you should be adding to your watch list. Next on our list is Expedia. This American online travel company and the marketplace have been known for information about travel services and websites. Right now, the one chart in Expedia is turning sets with a 52-week low of 136.77 and a 52-week high of 217.72 cents. Looking at its one-year price chart, we will realize that they hover between 140 to 180 per share for most of last year. Last year, their market cap is $30.944 billion, and what I really like about it is the very low 5-year expected PEG ratio. And as far as profitability is concerned, they have a profit margin of 0.14 and an unfortunate very low return equity of just 0.4 in the last 12 months. They have made about $8.6 billion of revenue and they sit on total cash of $4.31 billion. Their current ratio is 0.87 and it is between a buy and a hold. Their company's revenue increased to nearly 150% year over year, reaching over $2 billion. The word impressive is an understatement. What is the largest driving factor behind this huge growth? It's the same factor that has been encouraging many other stocks. Sickly declining pandemic concerns and relaxation of the pandemic limitations. Expedia has significantly benefited and is still taking advantage of the huge surge in travel. The chunk of their profits came from travel insurances, car rentals, and lodging. The sales of airline tickets and travel advertising also went up, and this is the reason why we think that Expedia should also be in your top pick. The next stock on our list is Ulta Beauty. This is a US-based company known for its cosmetics and nail products. Today, one share of Ulta is trading at $377.38 with a 52-week high of $422.43 and a 52-week low of $297.29. Last year, there is an overall increasing trend in its price, with a recent correction at the beginning of 2022. It has a market cap of $20.424 billion per ratio of 24.19, and earnings of 15.60 cents per share, and a 5-year expected PEG ratio of just 0.58. This means that we expect to see a lot of growth. Ulta is one of the examples of a very robust company with lots of cash. This can be used for reinvestment into the company's own businesses. Historically, they are known to have good growth since its stock has increased in value by 1,000% ever since it first came out in the market in 2007. It is said that the biggest contributor to this remarkable growth is the reliable evergreen catalog of products and their emphasis on consistent updates to match the current trends and standards in the beauty industry. Recently, we have seen Fenty Beauty by Rihanna that is heading to Ulta on March 6. Although this update will not immediately bring tremendous sales to Ulta, it is still expected to benefit them. Another test that Ulta has passed with flying colors is its redemption arc that followed during the pandemic. The company showed signs of a miraculous turnaround. Ulta has reported strong earnings throughout 2021. At one point, the company has even reported a 3,000% year-over-year growth in both revenues and net income. With this, Ulta is already one of the biggest and most influential companies in the beauty and cosmetic industry. These numbers show no reason to expect their growth to drastically change in the coming years. We look forward to them announcing their earnings, given that they have had stellar earnings reports in the past, especially with high analyst expectations too. We think that this is a really attractive long-term play, so that's why they are included in our list. Next on the list is Upstart. This lending platform is based on AI technology that partners with banks and other financial institutions to issue consumer loans. Looking at their 1-year price chart, you can see that they climbed sharply from August to October, and at the start of November, we saw a huge decrease in their price. Yahoo Finance has marked them as undervalued because if we check their profitability, they have a profit margin of 15.9%, and they have very good return equity of 24.46%. The company's balance sheet shows that they have total cash of $986.61 million. The current ratio is at 12.48, which is too high. Upstart is experiencing fantastic growth all throughout 2021. Their revenues have jumped every single quarter on a high note. They have nearly 250 year-over-year growth in revenue and nearly 6,000 a year growth in net income. The figures are ridiculously big, and the reason for this is basically their services are high in demand, especially for smaller banks that do not have access to the credit information. Recently, the company brought its platform to different lending markets, including auto lending and personal lending. There are clearly other markets within the industry that they can take advantage of. This shows that they have untapped potential in the home mortgage arena, which has a value of well over $1 trillion. In terms of yearly growth, once the expansion is successful, this could be the company's greatest asset. They already started repurchasing their own shares, which definitely shows the company's willingness to reinvest in themselves. This shows a lot of confidence in their growth and trajectory. There is so much positive news published about this company, and Corning Credit Union has chosen Upstart to be their personal lending platform. They think that it is a good deal in the long-term perspective. Upstart does have a solid foundation in the foreseeable future. Okay, moving on to the next company on our list, we have Alaska Air. Alaska Air Group is a US airline holding company known for its Alaskan Airlines and Horizon Air. The thing is, 1 year ago, they were trading at around $70 per share and dropped down to the mid-50s. However, ever since then, we saw a positive upward trend in the price. The company's valuation has a price-to-book ratio of 1.95, and the profit margin is at 7.74%. There is a decent return of equity of 14.08. Their total cash is about $3.12 billion. The current ratio is at 0.98. Overall, analysts are eager about this stock and expect that it will increase by about 33% in the coming months. The question is, what is Alaska Air Group doing to justify these positive predictions on their stock? For instance, the companies are growing steadily last year and had an impressive year-over-year growth rate of 135 in revenue. The net income is 104 million. The numbers are steadily growing in terms of revenue, from nearly 800 million to nearly 2 billion last year. This is another bullish sign that Alaska Air Group is doing well in the airline industry. They are seen boosting their customer base through the launch of the first ever subscription service in the US, where members will pay a monthly subscription fee and can earn a number of flights per year. This is definitely a logical step for this company, and an advantage now that subscription-based businesses are booming. The company is also confident in its own expansion of its aircraft. This could only mean that they are one of the stocks in the market worthy to watch out for. There you have it, guys. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.